Hi, my name's Tom Elliott. Welcome to another financial market update for Hodges Real Estate. Okay, the international economy, quite a few interesting things happening. Firstly, the US economy continues to improve. I do sound like a broken record having said this, but economic growth appears to be on the up. Unemployment is steady at the moment at around about 6.5%. I would not be surprised if within 6 to 9 months the Australian and American unemployment levels cross over. That's good for the Americans, bad for us. A couple of other interesting things that are happening. The Chinese economy appears to be slowing, and we're seeing this most noticeably in Australia via the cut in the iron ore price. It has recently fallen to below $100 a tonne. This has been reflected to a limited extent in the share prices of both Rio and BHP, but smaller iron ore miners like Fortescue, Atlas and so forth have seen their share prices take a bit of a tumble of late. The other thing that China has done, however, which is a more positive thing for the future, it appears to have finally got rid of its one-child policy. Now, recent population growth experts have been suggesting that fairly soon India's population will surpass that of China. India has no controls over how many children are born. The Chinese finally appear to be realising that if they do not have children, that eventually their workforce will age, much as the Australian one is doing. As a result, China's one-child policy is now gone, and we should see in the next decade or so China's population growth start to accelerate once again. Not good for the greenies amongst us, but very good for Australia. Okay, well, the local economy. Now, unemployment steady at around about 5.8%. Good news there. Inflation, the last quarterly inflation numbers that came out showed inflation stuck at around 2.8, 2.9%, although if it does go above 3%, that's not good news for the Reserve Bank. Now, speaking of the Reserve Bank, the RBA has made it clear that rates are on hold for the time being, and most forecasters out there think that the 2.5% level at which the official cash rate now finds itself will in fact be locked in for the best part of the next year. Still, I would watch those inflation numbers. They are the things that the Reserve Bank is worried about, and if it goes above 3% or stays above 3% for quite a while, we could see interest rates start to tick up. The Australian dollar steady at around about 92.5, 93 cents. The $8 caught in some real cross currents at the moment. On the one hand, the US economy is improving. That should push up the value of the US dollar and push down the value of our dollar. On the other hand, people still like to buy the $8 because it's a proxy, not just for China, but for Asia in general. We are now the fourth most traded currency on earth. We are a proxy for Asia, and to the extent that people feel positive about Asian economic growth, well, they like to buy the $8. So some people say the US dollar should go up, others say the $8 should go up. At the moment, that's why it's 10 cents off its high, but well off its lows. All right, the federal budget, and that is the main thing that has happened over the past month. Now, this is one of the most unpopular budgets in recent years. I cannot think of anything apart from maybe the introduction of the original mining tax by Kevin Rudd that really got people's ire so up. I guess the main aspects of it, the $7 GP co-payment, this one is universally unpopular. It sort of breaks that Medicare promise that all Australians, irrespective of their income, can enjoy free and competent health care. I don't think this one will get through the Senate. Clive Palmer doesn't like it, Labor doesn't like it, the Greens don't like it. I don't see that the Senate passing this one, so either it gets rejigged or it gets abandoned altogether. The 2% deficit levy, that's going to be added to the income of people who earn more than $180,000. Actually, more correctly, it'll be subtracted from their income. It will be added to their rate of tax. The top marginal rate of tax is now 49%. And yet at the same time, the government is cutting the company tax rate to 28.5%. That creates a 20.5% gap between the top personal marginal rate and the company rate. That, I think, is the widest in the OECD. And what it means is that many more people will look at negative gearing, they'll look at trying to restructure their affairs within trusts and companies and so forth to avoid paying this very high top marginal rate. 20% plus is a huge margin, and it's not good tax policy. Another thing the government has promised to do is start re-indexing the petrol excise. John Howard stopped this back in 2001. Had he not done that, petrol would now be about 22 cents a litre more expensive than what it is. The re-imposition of this indexation will add about 1 to 1.3 cents a year to the price of petrol. Won't be noticed in the short term, but in a decade or so, people will certainly feel it. The weird thing is that the money raised from both the Medicare co-payments and indeed the petrol excise is not going to pay down debt. It's going into, well, in the petrol case, to build roads. In the Medicare case, it's going to form a medical research investment fund. So again, I don't really understand why the government is taking all this political pain for policies that won't actually reduce our debt. Speaking of debt, deficits are going to remain in place for probably the next 5 years, according to the government's own figures. So it's going to take 5 years of debt continually going up before we even start actually making inroads into it. Again, the budget is so unpopular, and yet it does not deal with the government's main stated concern, that is the high and rapidly growing level of public debt in Australia. Tony Abbott has taken a huge pummelling in the polls. Some recent ones have him losing 56 to 44 on a two-party preferred basis. There is a very real issue now that Tony Abbott could be a one-term Prime Minister. It's a long time since that's happened, but it could be happening with him. People do not like broken electoral promises. And finally, the government's promise in the longer term to reduce funding to the states means that eventually I think the states will have to beg the federal government for an increase in the GST, and that's something that actually would be good tax policy, although of course it will be very, very unpopular. So what does all this mean for the local real estate market? Well, clearance rates have actually dropped back a bit in the last few weeks. They were running at around 75-76%, right now somewhere between 69 and 73% over the past few weeks. Price growth, it's still there, but it's probably rising at a less rapid pace, more like 5, 6, 7%, not the 10% per annum that we'd been seeing more a couple of months ago. Asian buyers still very much a force in the Melbourne market, certainly in the eastern suburbs. The desire of wealthy Chinese people to get money out of their country and into Australia appears to continue unabated, and my prediction is they will be a force in our real estate market for many, many years to come. We keep hearing reports of auctions that are being conducted in Mandarin, less so in English, and that really tells you something, doesn't it? Overall, the budget really had very little impact on property investors. I was worried there might be some changes to, say, negative gearing. There was not. There might have been changes to superannuation. There were not. So really, from an investment perspective, the budget was pretty good. From the perspective of wanting to buy your first home, or indeed another home, nothing has really changed. And overall, I spoke to the State Treasurer, Michael O'Brien, just over a week ago. He said that Victoria's population is now growing at 100,000 people per annum. That's an MCG crowd, a packed MCG every year. And of those 100, almost 90,000 people make their way to Melbourne. All these people need somewhere to live. By and large, that's positive for house price growth in this part of the world. Thanks very much for your company. I'm Tom Elliott, and I look forward to your company again, same time next month.